Michael Milken, and the rise of high-yield finance. In the high-stakes world of Wall Street, innovation can reshape entire financial markets. But sometimes, the same innovation that creates fortunes can also blur the line between opportunity and manipulation. In the 1980s, one man transformed corporate finance. He helped create a powerful new investment market. He built an empire worth billions, and he earned a legendary nickname. They called him the Junk Bond King. His name was Michael Milken, and the financial empire he built at Drexel Burnham Lambert would eventually collapse in one of the most famous security scandals in American history. To understand Michael Milken's rise, we must first understand the concept that made him famous: junk bonds. Traditionally, corporations raised money by issuing bonds to investors, but these bonds were usually issued by companies with strong credit ratings, firms considered safe investments. Companies with weaker financial positions had limited access to these markets. Investors were reluctant to buy bonds from businesses that carried higher risk. Milken saw an opportunity in that gap. He believed that companies with lower credit ratings could still attract investors if those investors were offered higher returns. These bonds became known as high-yield bonds, or more commonly, junk bonds. The term junk reflected their risk, but for investors seeking higher profits, they also represented opportunity. Michael Milken began promoting this idea in the 1970s while working at the investment bank, Drexel Burnham Lambert. His theory was simple: higher risk could be balanced with higher interest rates. If structured properly, junk bonds could finance companies that traditional banks refused to support. At first, many Wall Street executives dismissed the idea, but Milken persisted. Gradually, investors began buying these high-yield bonds, and a new market began to emerge. By the 1980s, junk bonds had become one of the most powerful forces in corporate finance. They allowed companies to raise billions of dollars quickly. Entrepreneurs could finance ambitious expansions. Corporate raiders could fund massive takeovers. And investors chasing high returns poured money into these risky but profitable bonds. At the center of it all was Michael Milken. Working from Drexel Burnham Lambert's office in Beverly Hills, Milken built a vast network of investors and corporate clients. His influence grew rapidly. Companies seeking financing came directly to him. Investors trusted his ability to structure deals that delivered high returns. For years, Milken appeared unstoppable. By the mid-1980s, Drexel Burnham Lambert had become one of the most powerful investment banks in the United States, and Michael Milken was its most valuable figure. His compensation reached extraordinary levels. Some years, his earnings exceeded $500 million. On Wall Street, he was both admired and feared. Supporters saw him as a financial innovator. Critics believed he had created a dangerous system built on excessive risk. But the junk bond market continued expanding, and with it Milken's power. Yet behind the success, serious concerns were emerging. Regulators began questioning whether Drexel's junk bond deals were being conducted legally. Investigators suspected that some transactions involved insider trading, market manipulation, and violations of securities laws. The expanding junk bond market had created enormous financial incentives. And those incentives, prosecutors argued, had pushed some deals beyond the boundaries of legality. The investigation intensified during the late 1980s. Federal authorities examined relationships between Milken, corporate raiders, and investors. They searched for evidence that confidential information had been used to profit from takeover deals. Gradually, the pressure on Drexel Burnham Lambert increased. In 1989, the investigation reached its peak. Federal prosecutors charged Michael Milken with multiple counts of securities fraud and insider trading. The charges alleged that Milken had manipulated markets and violated financial regulations while managing the junk bond empire. Facing overwhelming legal pressure, Milken agreed to a plea deal. He pleaded guilty to several felony charges related to securities violations. In 1990, he was sentenced to prison and ordered to pay hundreds of millions of dollars in fines and restitution. The scandal sent shockwaves through Wall Street, and the consequences did not stop there. The financial institution at the center of the scandal, Drexel Burnham Lambert, could not survive the damage. under intense legal and financial pressure, the investment bank filed for bankruptcy in 1990. One of the most powerful firms of the 1980s collapsed almost overnight. The junk bond empire that had fueled corporate takeovers throughout the decades suddenly crumbled. The fall of Drexel Burnham became one of the defining moments in modern financial history. Yet the story of junk bonds did not end with the scandal. Despite the controversy surrounding Michael Milken, the financial instrument he popularized did not disappear. High-yield bonds continued to play an important role in corporate finance. Today, junk bonds remain a major part of global capital markets. Companies still use them to raise funding. Investors still pursue them for higher returns. Milken's innovation reshaped finance even after his downfall. The legacy of Michael Milken remains complex. To some, he was a visionary who democratized access to capital. He enabled smaller companies to compete with established corporations. He opened financial markets to businesses previously excluded. To others, he represented the darker side of financial innovation. A world where aggressive deal-making, enormous profits, and legal boundaries collided. The junk bond era of the 1980s became a symbol of Wall Street excess. A time when massive corporate takeovers, leveraged buyouts, and speculative finance dominated headlines. Michael Milken stood at the center of that transformation. His rise demonstrated how financial innovation can reshape markets. But his fall revealed the risks when power, profit, and regulation collide. Today, the junk bond scandal remains one of the most studied financial episodes in modern history. Business schools analyze it as a case study in financial innovation and regulatory oversight. It reminds us that markets are constantly evolving. New financial tools can create opportunity, but they can also create risk. Michael Milken once built an empire on high-yield debt. He helped change the structure of modern finance. But his story also shows that when financial power grows too quickly and oversight struggles to keep up, the consequences can be enormous. Because on Wall Street, innovation can create fortunes. But when ambition outpaces accountability, even the most powerful empires can collapse.